Hi folks, welcome to our newest video. My name is Matt Cheney and we're going to meet someone very special to me today. You're going to meet my mom. Mom,
hello.
Thank you for agreeing to join us here. Today we're going to be potting some plants, right? Or we're actually be potting what, oregano?
We're repotting our oregano,
okay,
so it
very
has
good.
more room to grow.
And that's for pizza, I assume, right? For the granddaughters?
Well, it's good in all sorts of things like tomato sauces and stuff like that.
Okay, so you've been living here in Bethesda for a number of years, right?
Right, we moved here in 1980.
1980,
yes.
And you've been here during some pretty exciting times for Bethesda as downtown Bethesda's been built up, property values have soared. You're probably even part of the Bethesda Urban Partnership at one point.
I was on the Urban Partnership.
What's it been like being here in Bethesda during these exciting times?
Well, it's been very interesting. It's been a great place to live. I really love Montgomery County, which is our county, and that's the local government. But I was trying to think of just the other day about what Bethesda was like in 1980 when we moved here, and I remember that most of the buildings downtown were 1 and 2 stories.
Right, I remember that.
And you remember the Marriott Hot Shops?
Yes, I do.
There was a Marriott Hot Shops right where the Chevy Chase building is now.
I know, right?
It was so hokey in some ways, but it's really grown up fantastically. And I was just driving down Wisconsin Avenue the other day and looking at these new skyscrapers and the glass fronts. It just reminds me so much of Manhattan. I mean, it's such a different feeling. It's the big city now.
Back in the 80s and 90s, you were kind of in the same industry as me. You were a mortgage loan officer or a banker.
It was related. I was everything. I worked for savings and loan.
Okay.
I worked for a mortgage company. I worked for a broker. I've worked throughout the gamut.
A mortgage broker and
a mortgage banker.
Okay.
They're different things. They're different, and it's savings and loan. There aren't many savings and loans remaining anymore, but I worked in downtown Bethesda in the Metropolitan Federal Savings and Loan.
Okay.
And that's where I got my start in the mortgage business, and I had really liked the mortgage business a lot. So after I spent a year there.
What did you like so much about the business?
I like numbers, I guess.
Okay.
And I like dealing with people, but I like more their financial side rather than the contract side, I guess, and the real estate side. So
you liked manipulating the numbers to get them the best mortgage payment, the lowest mortgage payment?
Sure. And that was, but I started out at Metropolitan Federal Savings and Loan in 1983. And then in 84, I moved to Merrill Lynch Mortgage because Merrill Lynch at that time opened up a real estate outfit or branch of its business. And they had a bunch of real estate offices, one in Bethesda, and then they also opened up a real estate mortgage company, which I joined right out after spending about 2 years at Metropolitan Federal.
Okay.
And it was a different kind of animal in the sense that you were on commission when you go and work for mortgage brokers and bankers and that sort of thing.
What's the difference between a mortgage banker and a mortgage broker?
Primary lenders such as, let's say the S&L Savings and Loan I first worked for, they make the mortgage. They give the money to the mortgagee, to the person who's taking the loan on their home directly. But you go to a mortgage banker and they may give you the money directly, or they may give you a temporary mortgage and then sell that mortgage to an investor, such as Fannie Mae or Freddie Mac. And then when you go to a broker, they don't give you the money directly at all. It's all sold.
Of people getting loans for their houses, what's the percentages? How many people are getting them from bankers and how many of them are getting them from brokers? Is there kind of a rough number? Is it like 50-50?
Bankers,
70-30?
mortgage bankers today are like brokers too. They have lots of different investors. So
you could go to Wells Fargo and they might be selling you a Bank of America type loan or something like that?
Well, Wells Fargo, sure, but
not necessarily.
I don't
like
think that's going to happen.
I'm just trying to kind of simplify it.
Right. But yeah, it could be.
Okay. So interest rates have been hiked up recently because the Federal Reserve Bank raised interest rates. Do you see any similarities with what's going on today with interest rates going up, almost doubling?
They go up and down all the time.
Was it like that at your
I remember when I started in the mortgage industry in '83, rates were really, really high. And as an example, I remember, and I think a lot of adjustable rate mortgages were around then. You had a 1 year, a 3 year, a 5 year, and then of course the 30-year fixed, which nobody wanted because the interest rates were so high.
You would get a 1 year arm
at the time,
because you would assume the rates would go down the following year, and the banks were okay with that?
Well, yeah, you make sure there's no prepayment penalty such that you can refinance at any time and get a new mortgage.
Okay.
But let's see. So in '83, I remember, I think that the 3-year ARM was something like 11%, which is a lot higher than it is now.
11%.
Yeah.
Okay,
Whereas
so
now,
we're kind of
you've
around.
got your 30-year fixed is not even yet, maybe it's around 6%.
It's about 6%.
So,
yeah.
I mean, my gosh, let's get real here.
It's not a big deal.
It's not a big deal. We have ups and downs. I remember that when we purchased this house, we got a mortgage in '84 of 12.5%.
12.5%
Right.
in '84.
In
Okay.
'84.
What were you thinking?
We thought we were getting a good deal.
Did you want the house and you didn't
Well,
really care about the
actually,
rate?
we bought it from Mr. and Mrs. Twetton.
Okay.
And they financed it for us.
So you got a
homeowner finance.
Homeowner finance loan. Okay.
Right. Such that, because I was looking at the note the other day, and it was such that it was a 30-year rate, but after 10 years we had to pay it off.
Okay.
So
it had a balloon payment.
I wrote the contract, and we offered the mortgage, we wrote in the contract what we wanted with the mortgage, and then we had basically agreed on everything.
And then, so you were at 12% for what, 2 years?
2 years, and then
what did you
we
refinance
refinanced at 9.5%.
9.5%,
and then the rates were coming down.
And then did you
And then in the 90s, adjustable rates, things were coming down, and they came down a lot. So I remember we had a 2-year period where we had a 1-year ARM at 4.5%.
4.5% for 1 year. Okay.
Yeah. So, but then we refinanced again because the rates were coming down and the fixed rates came down. So
Okay.
What did we refinance into? I think we refinanced into about 7% with OBA.
So
oh, look, here's Yoshi. Hi, Yoshi.
Hey, Yoshi. So
Yoshi's visiting.
So to boil it down to someone who's watching the video right now,
Right.
and how this is relevant to them, is if you see a house today and you want the house, buy the house, finance it today at today's rates, and rates will potentially get better, and then renegotiate the rate at that point.
Exactly. Just
so
make
it's really,
sure.
Buying a house shouldn't be based upon whether or not rates are going up or down. It's if you're ready to buy a house, you want to live in the house, you want to commit to a house,
Right.
then buy the house and get the best term you can get now,
Right.
and then keep your eye open for a year from now or 3 years from now to refinance.
Yeah. Or maybe it's going to be 5 years. You just don't know.
5 years. And if you live in the house for 7 years, then potentially you could get a 7-year ARM.
But yet again, maybe if you get a really low rate, like what people have gotten these days,
Right.
never need to refinance. I
Right,
mean, my
true.
heavens, the low rates were what, down in the 3s at one point?
They were at the 3s, but I'm talking about more for folks who might be in the market today.
Today. Well, to me, 6%.
6% means you should.
Sure.
Absolutely.
I mean,
There's no reason not to be buying
Of
more
course.
rates are at 6%.
Right, right. Don't
'Cause-
panic.
Yes. Okay.
Yeah, that's my thought.
Well, I think that's relevant because some folks, they've gotten used to being at 3% or 2
Right,
and
right.
2 and 3/4 or what have you, and then see rates double is kind of a shock to the system.
But look at the cash flow.
Look at the
That's
cash flow.
the way I always try to do it. Look at your income and look at
Okay.
your outflow. And how much does the mortgage payment change?
If it doesn't change dramatically, then.
I mean, do what you can afford.
So before you were a loan officer, selling loans, helping folks buy houses with loans, you were a realtor in Houston.
I was, yes, in little West University
West
Place.
University Place. Did you at that point in time envision any one of your 3 sons following you into the business?
Well, my kids were all so little, I never thought about it. But I'm totally pleased.
Yes.
Yes, so it's great, for sure. Yeah.
Well, thank you so much for taking the time.
Absolutely
We
fun.
didn't make much progress.
We didn't make any progress with our
Yes.
planting at all.
No, but we'll have to make sure we plant the rest of this. And let's say goodbye to everybody and thank them for joining us.
Okay.
Thank you.
Thank you.
Thank you for joining us today.